Hi everyone, welcome to this month's Financial Markets Update. Well, March proved to be another really interesting month for financial market performance, and there were probably three key aspects to the month of March. We had the US Federal Reserve begin its rate tightening program. They increased official cash rates by 0.25%, so 25 basis points to take the Fed funds rate now to 0.5%. We saw commodity prices continue their march north, particularly oil and natural gas. Oil was up over 10% over the course of the month, while natural gas was up incredibly 28%. A lot of that was driven by the war in Ukraine and obviously the challenges around the energy supply, particularly for Western Europe. And then we saw the significant divergence between the ASX 200 index, which was up over 6.5% during the month of March, again, predominantly driven by higher commodity prices feeding through into the performance of the energy and materials sector, as well as the sell-off in the local bond market. Our 10-year bond yield was up over 70 basis points during March, and that saw the local market decline by over 3.5%. So the variance between the bond market and the equity market was over 10.5% in March alone. And again, probably an unusual occurrence when you think about the geopolitical risks that we're seeing globally, as well as obviously the increasing number of challenges in terms of growth outlook and, as I said, the inflation side of things, which really drove the sell-off in fixed income markets, as I said, with the US Fed beginning its rate tightening program. We expect the Fed to actually increase official cash rates by 0.5% at its next move, as I said, given the fact that inflation in the US is running well north of 7%. And domestically, the RBA even alluded to potentially increasing rates through the second half of this year. So, as I said, that didn't help our local bond market performance, just given some of that anecdote as it relates to official cash rates here. When we actually look at the performance of bond markets and just try to highlight this in the context of a chart, and really, the sell-off is not unexpected when you see bond yields rise as aggressively as they did. As I said, up 70 basis points during the month of March alone, but they're up close to 200 basis points since the low point over the last couple of years. And this chart here just gives you sort of three different periods of performance of both the 10-year bond yield as well as obviously the local bond market. You can see in periods 1 and 2 from this chart that bond market performance is either positive or generally flat to positive in an environment where bond yields either are flat or declining, and you can see that quite clearly. But when we get periods where bond yields move up significantly higher, that has a big negative impact on the performance of the broader market, and that's got to do with, as I said, the what's known as duration, the impact that has on overall performance. So, what we're seeing at the moment is not uncharacteristic, but just the size and the sheer size of the moves is, and it's one of the reasons why we've been underweight bonds within our portfolios for some time now, just given that we felt that bond yields were too low. We felt that ultimately we would start to see some level of central bank tightening, or we would start to see some normalisation of the yield curve. Now, you never know what factors are going to drive that, and as I said, most likely in many instances has been higher commodity prices, which has pushed up inflation as goods and services increased, along with the overhang from COVID, particularly around supply and demand imbalances that are still quite prevalent globally, and that's had a significant negative impact, as I said, in regards to inflationary pressures. So as we sit here today, obviously bond markets are looking a little bit better value, but we're not of the view at the moment that they're outright cheap, and that switch between equities and bonds we still think is a little way off, because we do expect that bond yields are going to continue to move higher as central banks start to normalise, and certainly on the back that inflationary expectations are well above central bank targets. We do expect inflation though to start to moderate in terms of year-on-year prints through the second half of this year, and we think that will provide some opportunity for bond markets to start to equilibrate and provide some opportunities to increase our asset allocation, particularly with yields running north of 3%, which we do believe that we'll get to throughout the course of 2022, both domestically as well as on a global basis, particularly in the US. So a really interesting market throughout March. As I said, the variance between equities and bonds over 10.5% was significant, biggest I've seen over the last decade or so, and I think it does point to some of the challenges that are clearly still very prevalent across financial markets, and the importance of having a well-diversified and well-thought-out portfolio in the context of managing both equity as well as bond market risk. As we've seen through the first quarter, bonds can give a negative return, and it's not always the case in stressed market environments that they're going to give a positive return. As I said, in this environment at the moment, we think bonds are still facing a number of headwinds. As always, if you have any queries about your portfolio, please feel free to reach out to anyone in the team, and we look forward to catching up again next month. Thanks, and bye for now.